Hello. It looks like it's the season for bonds. There are a plenty of NCDs and bonds out there coming up with primary offer. And there are also many bond platforms that have come up now that are giving you secondary offer of already existing bonds. This development has happened because SEBI has recently brought online bond platform providers under its fold. So these platforms will now be regulated by SEBI, and that basically means retail investors have more opportunities to invest in bonds. But before you do that, there are a few things that you need to know about bonds in case you're new to bonds. So let's look at them. So most of us who invest in bonds think bonds are as safe as deposits. You go to a bank, you invest in a fixed deposit, you do believe that your money is safe, there is an insurance, etc. And therefore, when bonds offer higher returns than bank deposits, you immediately pounce on them thinking that this is a better offer than what my bank is offering. But what you need to be aware of is that these NCDs or bonds are not, similar in risk as opposed to your deposits. The reason is as follows. One, these NCDs or non-convertible debentures are basically issued by companies, uh, and for these issuances, they are not governed by RBI, unlike deposits, right? So when it comes to deposits, whether it is your bank or some NBFCs who take deposits, RBI actually regulates it in terms of the amount they can collect, the amount of reserves or net owned funds they should keep aside when they collect such deposits. They even cap the time frame, they even cap the maximum interest that can be given, and all of those. So there is a lot of stringent rules that a deposit taking bank or NBFC has to follow. None of those are really applicable when it comes to issuance of bonds and non-convertible debentures. So essentially, if for example, let's take a company like Cholamandalam Investment. They are a non-deposit taking, non-banking finance company, non-deposit taking NBFC. So that basically means they cannot tap deposits from you. So they take the NCD route. So they issue bonds and those bonds are traded later, right? But because they do not have the stringent rules as deposits, nor do they have insurance like your bank deposits, definitely the risk in bonds, although you're supposed to get your capital back, there is always a risk, that you may not get your capital back if there is any event that is negative for the company. The other thing is the risks of deposits of bonds can vary a lot, right? We have something called AAA bonds, then AA plus, then AA, the A plus, and so on. So, and they can go even below A plus. Typically, this AAA, AA plus to AAA is considered investment grade for retail investors, but you will see in some of the platforms today available bonds with triple B rating. They are actually non-investment grade, not meant for retail investors. So this distinction is very high within bonds. They are not that high in deposits, because all banks, for example, have to follow whatever the RBI says in terms of providing for those deposits or the rates. Even non-banks, if they are a deposit taking NBFC, they have to follow certain rules. None of those are applicable here, so the risk varies a lot, and the risk is definitely far higher than deposits. The other thing that, a misconception that is there with bonds is that if the term secured bonds is used, you think that it is very safe. Yes, theoretically, secured bonds are bonds that are backed by some asset, right? It could be, secured against, say, the assets of the company, the fixed assets, or any other, asset or receivable that they may have. But what in practice, what happens is that, or even, if a company is not very reputed, it may have all its assets, but when it goes bankrupt, really, none of those may even be available in reality, right? Those may be assets that were seemingly had value, but whose worth would be nothing at some point in time. And we saw this in the case of Diwan Housing Finance. Investors actually had to take significant haircut, even on their secured bonds. So there was no money to really repay, these bondholders. So you could have an unsecured bond from a very reputed, company and still be safe, or you could have a secured bond from a risky company and still be unsafe. So it's very important to first understand the nature of business that this company is doing, and whether those kind of assets are really tangible, they can be encashed when there is a situation. For example, companies that give a loan against gold. Gold is a very tangible asset, right? Tomorrow, if there is issue with getting their money back for the money that they have lent, they can always use this gold to encash and pay you back. Similarly, loan against property. So those are very, very tangible assets. Whereas loans that you give, the end users say some business loan, small scale loan and all that, even though there may be security, your money might not come back to you or might not come back in the same quantum that you gave. So be aware that secured does not always mean safe. The very important thing, when it comes to bonds, you may have been told, look at the ratings of the bonds. If the rating is very high, that's great. But what people don't probably tell you is ratings can change. So it's not enough that at the time of your, buying this bond, the bond had high rating. Later, a year down the line, the rating may actually have slipped. Say a AAA could have gone to AA, or a AA could have gone to A, or even below investment grade, right? So it becomes very important to monitor ratings, especially if the company is already a bit of a risky company. If a downgrade happens, what is happening to my bond? Am I going to get interest regularly? Is there a risk that there'll be default, and so on, right? Um, Therefore, at the time of entry, don't just look at the actual rating, see history as well. What if this bond is actually a downgraded bond? Probably it was downgraded from AAA to AA 6 months ago or 3 months ago. So if you go to the rating agency site and just simply search for the name of the company, you will get the history of the rating. So that's very important, since high ratings are not foolproof, and you don't know whether this company is on a slide now, that it was already downgraded, and it may be further downgraded. That risk you will know only if you look at the history. There are cases where companies are being upgraded, which gives you more confidence in that case, right? So this is a very important factor rather than looking at the absolute rating at present alone. The other important thing is, now that all these online bond platforms are available, they have to be compulsorily listed. There are also bond providers selling unlisted bonds, but here these OBPPs, as they are called, have to give listed bonds. Now, in listed bonds, most of us take comfort that if something is listed, you will be able to trade. That is not always the case, especially in the Indian market. The debt market is not very liquid, barring the popular tenure gilts G6. There is not much trading happening in corporate bonds. Maybe the AAA, some of them get traded. Most of them are buy and hold. So there is not much. There won't be much takers in the market when you're trying to sell when you want to. So lack of liquidity, and sometimes these bond platforms may give you an opportunity to liquidate through them. Probably you won't be able to do it through the exchanges, but they may be willing to buy if they have a counterparty, of course, right? So when you get into these bonds, please be aware, if you go for very long tenure, you should be able to hold those bonds for such long tenure. If you're able to sell it in the middle, fine, but don't go with a tenure mismatch. If you have going for a 3-year bond, but you really want this money in 1 year, don't think that you'll be able to sell the bond early. You may not be able to, or you may suffer losses while doing so. So please try and match the tenure of your own investment requirement with that of the bond to ensure you're not hit by any liquidity issues. The last thing and very important thing, of course, is returns of any bond, right? In many places, when you are sold, distributors sell these products, they only tell you the coupon rate, which is the interest. That is fine if it is a primary market offer. That is, the bond is being issued for the first time at, say, 10 rupee or 100 rupee face value, and you have, say, an interest of 9% or 8.5% and so on. But when you are buying this bond in the secondary market through these bond platforms, what really matters to you is the yield, not the interest rate. The interest rate is called the coupon. The yield, like we have explained here, is the residual interest income that you will get from this bond for the price at which you enter. In other words, the interest, a component, and the price component. A 10 rupee bond may be today trading at 12 rupees, right? So at 12 rupees, what is your return on this bond? Or at 15 rupees, what is your return? Or at 8 rupees, what is your return on this bond? So that's what yield tells you. And that's why in secondary market offer, you always look at yield and not just the coupon. Coupon is the income that you will anyway get, but that's not your real returns, right? So if you just draw an Excel and put your initial buy price, put all the interest, and then the final face value amount that you will get, calculate an XARR, it will be your yield, right? Of course, if there are interest payouts, you make the calculation as payouts. So you should be aware of this difference. But if yield is very high, will you immediately think that it's very attractive? Not necessarily. You have to look at what is called as the spread, right? Spread is nothing but the excess that a bond gives you over a risk-free instrument. For us, the risk-free instrument is the GSEC. So, similar tenure GSEC versus similar tenure bond. Now, this difference, whether it is high enough, whether it is higher than average, right? So, you might actually see a bond that is 13% yield with another being 10%. Remember, the risk is not the same. Naturally, the 13% yielding bond has higher risk, and therefore it's trying to compensate you with a higher spread. The 10% bond has a lower risk, and possibly its spread may be lower, but even that may not be always the case. Let's just look at a simple example. These were yields as of September 5th or so. So it's just to illustrate. Look at the government risk-free 5-year tenure that I have put here. It's 7.17, right? Supposing somebody comes up, a AA instrument from an NBFC comes up with 9.5% yield for 5 years, right? So look at what other AA instruments are already at 9.42, right? Now the spread is 9.42 minus 7.17. But if I'm going to get another AA, which is only little more than average at 9.5, I'm not getting anything unique. And for all you know, this particular AA instrument may carry a higher risk than the average that we have put out here, the average of many other bonds that we have put out here. So this spread should at least, be slightly higher than the average spread. So 9.42 minus 7.17 is your spread. If you are going to take a AA and you think it's attractive, then its difference from GSEC should be at least significantly higher than this, right? So that's something that you need to keep in mind, in the sense interest income is just the cash flow that you get, but your real return is the yield. You should not look at absolute yield when looking at an instrument. You should look at the spread. How much is it giving for similar tenure? Please remember, do not compare a 5-year and a 10-year or a 3-year and a 5-year and so on. For similar period, what is it that I'm getting in the market, and whether I'm getting a better deal. How will you know all of these? Some of this information may not be readily available. Of course, at PrimeInvestor, we do curate this for you, and we do come up with our call, and that's called Prime Bonds. You can check them out. It is available for all growth subscribers. But we do also help you understand how to filter these bonds. So in future videos, we will actually go about explaining how you can filter these bonds, and also what to look out for in bond platforms, right? There are multiple bond platforms. How should you choose one that is fitting your requirement? Otherwise, you'll end up opening in multiple places. We'll discuss all of these in upcoming videos. Do look at the link below, where we have explained all the jargons relating to bond market. Aarti Krishnan has done a very fine job of that. Do take time to read that, and do subscribe to our channel so that you will know more about bonds in the upcoming videos.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.